the expectations that the Federal Reserve will raise interest rates in December have risen to 68%, almost 70%, while about a week ago the expectations were equal to about 65%. There will be another meeting of the Federal Reserve on November 2nd, but neither analysts nor the market players don't seriously take into account this November meeting of the Federal Reserve, because this meeting will take place before the US presidential election on November 8th, and the Fed is not expected to act until we know who is elected America's next president. This is why the main speculation, the main talk is around the Federal Reserve December meeting, and during the past week, the market has begun to price a higher possibility that the Federal Reserve will finally raise interest rates after a year of inaction. I remind you that the last time the US Central Bank raised interest rates was in December 2015. Because of this increased expectations of the Fed's December tightening of monetary policy, US dollar managed to strengthen. We are watching US dollar index weekly chart. US dollar index tracks the dynamics of American currency versus the currencies of America's 6 largest trading partners. And we can see that there was firstly a big bullish break, and then the books managed to continue pulling US dollar to the upside. Actually, there is space for American currency to get higher, to approach January maximums just below the benchmark level of 100 points. Also, there were comments from the Federal Reserve Chicago Fed President Charles Evans on Monday, and he said that the Fed could raise interest rates 3 times between now and the end of 2017 if inflation expectations and labor market continue to improve. So, hawkish comments. We know that opinions within the FOMC or the Federal Open Market Committee differ, but still every hawkish statement is currently bullish for the US dollar. There is more space for the US currency to strengthen as December is getting closer, because as we have seen, there is 70% that the Fed will raise rates in December priced in by the market according to CME. 70% is not 100%, so we have this scope for increase in the market's pricing of the Fed's rate hike. At the same time, we have another important event, US election, which will take place in 2 weeks. And as this election is getting closer, probably we'll see more calm situation at the market with low volatility and low trading volumes, as even large players won't take any sizable positions until their uncertainty, until the US presidential election has passed. According to Bloomberg, the volatility index has fallen to the lowest levels since the beginning of this year, actually since December 2015. This is the index calculated by JP Morgan Chase. And such decline in volatility can be explained by the speculation that the markets have already priced in enough of the US interest rate increase in coming months, and also the fact that Hillary Clinton is far ahead of Donald Trump in the opinion polls. US dollar has already strengthened on this as well. And such lead of Hillary Clinton increases prospects for stability of the currency market, of the US economy, and of global economy. So stability doesn't make market participants uncertain, doesn't make them worry. So volatility declined, and we see that after some sizable moves, the currency market is beginning to calm down, to settle down. Let's once again have a look at this expectations of the Federal Reserve's rate hike. Probably you are a bit tired to hear about these expectations of what the Federal Reserve will do in December, but I'm sure that the next 2 months will be still about the Fed policy, still about this December action or inaction of the Federal Reserve. So the possibility of the Fed's rate hike is something we will have to analyze just every week. We will have to monitor these changes according to CME. What else was interesting in the United States?